Thanks for tuning in. To kick off this portfolio update and how much it paid me in the month of January, my dividend stock portfolio is currently valued at just about $35,000. The portfolio has a weighted dividend yield of 2.25% and consists of 21 individual holdings across multiple sectors. Based on that yield, the portfolio has a PADI of $646. For anyone new here, PADI stands for Projected Annual Dividend Income, meaning this is the amount the portfolio is expected to generate over an entire year if dividends stay the same. This is not the dividends earned in January, but a forward-looking snapshot of the portfolio's income power. From a performance standpoint, the portfolio is off to a solid start in 2026, currently up 1.89% year to date, outperforming the S&P 500, which is up 1.14% over the same period. When I look at this portfolio, the biggest strength is the quality and diversification across all 21 holdings. This isn't a portfolio built around hype or speculation. It's built around durable, cash-generating businesses with long operating histories and strong balance sheets. On the technology side, I'm holding companies like Apple, Microsoft, Google, Texas Instruments, Visa, MasterCard, Automatic Data Processing, and S&P Global. Businesses that dominate their industries, benefit from long-term secular trends, and generate massive free cash flow. In consumer and defensive names, I have exposures to companies like Procter & Gamble, Pepsi, Hershey's, Colgate, Kroger, Nike, Home Depot, Starbucks, and Waste Management. These are brands people recognize, trust, and continue to spend money on regardless of economic conditions. Financials and healthcare are also well represented through JP Morgan, Johnson & Johnson, AbbVie, and Realty Income, giving the portfolio exposure to banking, pharmaceuticals, medical products, and real estate income. What I really like about this portfolio is that income is coming from multiple sources, growth is coming from multiple directions, and risk is spread across different industries. Overall, this is a high-quality, long-term dividend growth portfolio designed to compound steadily over time, not just pay dividends today, but grow that income year after year. During the month of January, I added 4 companies to the portfolio: Automatic Data Processing, Visa, MasterCard, and Microsoft. All 4 of these are businesses I consider high quality, white moat companies with strong competitive advantages and long-term growth runways. Automatic Data Processing gives me exposure to payroll and workforce management, a business that's deeply embedded in its customers' operations and generate extremely consistent cash flow. Visa and MasterCard strengthens the payment side of the portfolio. These companies benefit from the ongoing shift towards digital payments, operate with incredible margins, and don't take on consumer credit risk. And with Microsoft, I actually added more shares to take advantage of the recent dip. Microsoft is a core long-term holding for me, and when a company of that quality pulls back, I see it as a buying opportunity rather than a reason to panic. I'm aware that recent reports around Microsoft exposure to OpenAI have introduced some additional risk and have led some investors to question parts of the company growth story. That said, even if you completely take OpenAI out of the equation, I still believe Microsoft remains an exceptional business. The company continues to grow across its core segments, generate massive free cash flow, and maintains a dominant position in enterprise software and cloud. For me, Microsoft long-term fundamentals remain intact. Now, for the moment that you'll be waiting for, these 4 companies paid me a dividend in the month of January. Automatic Data Processing, $11.17, Nike, $5.64, Pepsi, $9.84, and Realty Income, $5.91, for a total amount of $32.62. It may not seem as much, but it surely helps in the compounding. Looking at the January dividends year over year, you can see the progression clearly, from $0 in 2020 all the way to $32.64. Now, it's important to put into context. January is historically a low-paying month for this portfolio, so I never expected to be one of the stronger income months of the year. The slight year-over-year decline compared to 2025 is also intentional. Over the past year, I've been high-grading the portfolio, meaning I sold some higher yield, lower growth dividend stocks and relocated that capital into higher quality businesses with stronger long-term growth and dividend growth potential. So while that decision may temporarily reduce income in certain months like January, the goal is to build a portfolio that compounds more efficiently over time, with faster dividend growth, stronger total returns, and more durable income in the years ahead. When I look at the annual dividend payout across the portfolio, what stands out is how balanced the income streams are. No single position is responsible for an overwhelming portion of the income, which helps reduce risk and creates more consistency over time. Some holdings contribute more meaningful to current income, acting as the portfolio's income anchors, while other play a supporting role with smaller payouts today but a stronger long-term growth potential. This mix is intentional. I want a portfolio that pays me now, but also one that has the ability to grow that income steadily year after year. The higher income position provides stability, while the lower yield, higher growth names help drive the future dividend increases and total return. Overall, the income is coming from a wide range of sectors and business models, which helps smooth out the volatility and prevents the portfolio from becoming too dependent on a single company or industry. This structure allows the portfolio to generate reliable income today while staying positioned for long-term compounding. This is the invested capital versus gain or loss. The main purpose of this graph is transparency, a different perspective from total return where you can see the invested capital in blue and the gain or loss in white. If the white bar is to the left of the blue, it means I'm in the red in that position. If it's to the right, it means I'm in the green. Some numbers are not shown due to chart sizing limitations, but overall, I've been putting this chart for transparency even though I prefer looking at the total return. When I step back and look at the total return across the portfolio, the overall picture is very encouraging. A large portion of the holdings are sitting on solid long-term gains, with several positions delivering substantial upside as the businesses have grown and compounded over time. At the same time, there are a handful of positions that are currently down or roughly flat. That's completely normal in a long-term portfolio and not something I'm concerned about. In many cases, these are high-quality companies where the fundamentals remain intact and time is doing more of the work than price in the short term. What matters most to me is that the winners have been able to run, while the underperformers are being monitored, not blindly averaged into. This creates a healthy balance where strong companies are allowed to compound and weaker performance doesn't dictate emotional decisions. Overall, the portfolio reflects disciplined long-term investing, a mix of patience, conviction, and selective opportunity when quality businesses temporarily fall out of favor. Total return is just one piece of the puzzle, but combined with growing income, it reinforces that this portfolio is doing exactly what it's designed to do. That will be it for this portfolio update. Thank you so much for watching. Consider subscribing for future updates since 2026 is just starting. If you're already subscribed, liking this video will be enough to push this video to new viewers. Thank you so much for supporting my content, and I'll see you in the next one.